Hello, good afternoon. You've tuned into Mutual Fund Corner on CNBC TV18. I'm Vinnii Motiwala coming to you from the Mumbai studio. Today we are turning the spotlight on debt mutual funds, a category that has seen a bit of a slowdown in terms of recent flows that came in for the month of November. However, when you look at in 2024, debt funds delivered a return of around 12 to 13%, showcasing the potential that they have. Now, as we look ahead to 2025, the debt market continues to appear in a bit of a tizzy. And what is it going to be? Is it going to be attractive to look at these debt mutual funds in 2025? Is this going to be the investor's choice? Should they be looking at it? That's what we'll be talking about with our experts for today. And to explore on this discussion, to talk to us about the outlook of the debt fund industry, we are joined by Rushabh Desai, founder of Rupee with Rushabh Investment Services, as well as Adhye, the founder of Udayan On Money. Good afternoon, gentlemen. Thank you so much, as always, for joining in with us on the show. And firstly, Happy New Year to both of you all as well. Yes, it's just the second day. We have a lot of days left, 363 days to be precise, to go through this new year. But, Rushabh, let me start with you. Overall debt market, what is it looking like? 2025 for debt mutual funds, what should we be expecting now?
Hi, Vinnii. Very happy New Year to you and to Udayan and to everyone at CNBC and to the CNBC viewers. I'm very excited. It's the first show, the MF Corner show of 2025. To put it very simply, I still feel that the debt market is very attractive for 2025 and 26. Calendar year 2024 saw returns in the range as high as 12 to 13%, 13% in absolute terms. Now, why I feel that 2025 is going to be lucrative for debt markets, there are three particular reasons, Vinnii. One is that the yields are still in the peak range. Okay, AAA bond yields are trading between 7-8% today. Second is that the interest rate cut cycle has not yet begun. We expected that the RBI would start the interest rate cut cycle by end of 2024, but unfortunately they haven't looking at the sticky inflation rate today. But we are expecting that the inflation should cool down and the RBI should begin the interest rate cut cycle probably from mid of this year or end of this year. This is number two. Number three is that there is a high demand for Indian bonds domestically and globally. Last year, we entered into the JP Morgan's emerging bond index, and from January 2025, we are going to enter in the Bloomberg emerging bond index. So a lot of money is going to be pumped in the bond market, in G-Secs, in corporate bonds, for domestically and globally. So I feel these combinations put together, I truly feel that superior double-digit risk-adjusted return can be generated from debt mutual funds over the next 1-2 years.
Okay. Double-digit is what one could maybe look at in the next couple of years. Udayan, your view on this, what are you looking out for in the debt market this time in 2025?
So, Happy New Year, Vinnii, Rushabh, and all the viewers. Glad to be a part of the first MF Corner show of the year. And with regards to the debt market, right, it's at that tricky position because we were expecting a rate cut. And by we, I mean investors. We were expecting a rate cut sometime in 2024. The RBI hasn't cut rates. So now the expectation is only increasing, especially when the RBI changed its stance to neutral. But at the same time, at that stage, Governor Das had said that even though we are changing the stance to neutral, that doesn't mean that a rate cut is in sight because we'll be looking at other factors as well. So I completely agree with Rushabh's point of view that even in 2025 going forward, the debt market can be very lucrative if you find the right categories of investing. And as it so happens, whenever there's an opportunity, there's also certain risk involved. So I'm sure we'll discuss that as well as we go along.
Absolutely. We'll want to know surely about that opportunity and risks. But, let's talk about those interest rate cuts, right? The trajectory that is expected this time as well. How does that, as a whole, if you could just go through the basics of impact the debt mutual funds, and what could we be anticipating on the back of that for debt mutual funds?
So we saw amongst the major economies, the Bank of England was amongst the first major economies to cut rates in August 2024. Then the US followed. US has already cut its rates by 1%. But the speed at which it was expected to cut rates, the Fed has stated that they will now reduce that. Instead of 4 rate cuts, they're hinting at 2 rate cuts. Now, all of this becomes relevant, and it specifically targets and impacts debt mutual fund investing, is because one of the biggest factors that influences bond mutual fund returns or bond returns in general is the interest rate that is dictated by the central bank of a country. Now, if the rates are cut, then potentially longer duration bonds, higher yield bonds, they become more attractive. So classic demand and supply, more people want to buy them. When they buy them, the price of those bonds increases. And that's how you get that alpha that even Rushabh was talking about, because a lot of people, they are not aware that bond mutual funds or bonds can generate returns in excess of 7-8%. But that excess 4 or 5%, 3-4% that you can get is through the bond price increase. The 6-7-8%, that is through the yield of the bond. So because of that, right? Because of that, it becomes very critical, because if rates are cut, then these bonds become attractive. They become attractive if you're holding them, then you just get that higher alpha. So that's why this year becomes very crucial, because all of us, I think, are expecting a rate cut, right? At some point, whether it's the February or some other MPC meeting that happens later in the year.
Absolutely, we are expecting some bit of a rate cut here. And Rishabh, would you like to add any thoughts furthermore to this one as well, in terms of debt mutual fund that we should be watching out for now, given the interest rate cuts are something that everyone is expecting?
Vinnii, I think, looking at the low growth rate, the low GDP growth rate of Q3, which is somewhere around at 5.4%, RBI should, cut rates to push growth. Keeping inflationary concerns in mind, especially food inflation, I think that the interest rate cut, as mentioned earlier, should begin probably by mid of this year or end of this year. We are expecting around 50 basis points of rate cut in 2025. Now, bond prices and bond yields are inversely related, Vinnii, right? So when the RBI actually starts to cut rates, the existing bond investors will benefit a lot, because there will be a huge demand for the existing bonds. And because going ahead, the falling of the interest rate clearly means that the new yields which will come in the market are going to be lower and not elevated. So I truly think, investors should take advantage of the elevated yields, because, Government of India is looking to consolidate the fiscal deficit also. And by doing that, they want to kind of, give a halt to the additional borrowing also. So I truly feel, investors should take advantage of the current high yields and venture into debt mutual funds as per their risk appetite and time horizon, Vinnii.
Absolutely. Risk appetite and time horizon is key. Now, I'm going to take that word risk and carry forward the conversation. And, you also mentioned about some risks being there here. Firstly, talk about those risks, as well as, if you could tell us, in terms of how an investor can balance that risk and return in the debt portfolio, given that economic uncertainty is there, whatever we may see in terms of 2025 coming in for us. What is it that we should do to balance this out?
So again, bonds are one of the most misunderstood concepts or instruments in the world of investing. But there's an age-old saying that goes that trust only two things with money, or in life rather: first your dog and then the bond market. Now, because of this, what tends to happen is specific bonds that are, say, maturing over a 3-year period or 4 or 5-year period, they are more sensitive to interest rates. So as interest rates go down, existing investors of those longer duration bonds, they will benefit from the interest rate cut. But at the same time, if that interest rate cut doesn't happen, then if you're holding that longer duration bond, and by longer duration, I'm using it in a very generic way, longer duration has a specific meaning in the world of bond investing, but let's not complicate it right now. So if you're holding that particular bond, like we have seen in the past 4 or 5 months, a lot of the major long duration bond funds, they haven't generated as high returns. Whereas in the first half of the year, they were absolutely on fire. And that's where we saw the 12, 13, 14% returns in those higher duration bond funds. But if that rate cut doesn't happen, then you're basically sitting on an investment that is not really growing as expected, or even say in line with other types of bond funds. And the RBI has constantly talked about the various risks that it is looking at, or the factors that it is looking at when it takes the decision to actually cut rates. And specifically, always mentioning inflation, The RBI knows that liquidity is some sort of a concern right now. The industry, large companies, medium-sized companies, they want liquidity infused in the market. One direction the RBI took in that regard was to reduce the cash reserve ratio requirements, but something special about interest rate cuts, right? Because that really infuses liquidity in the market. Now the thing is though, with regards to the RBI was very proactive when it started first started hiking interest rates after the COVID lows. But now, it just seems that maybe we are a little behind given what the industry is seeing. But at the same time, inflation becomes a concern. There are geopolitical tensions happening across the world. We import over 60% of our crude oil requirement. So, anytime there's any geopolitical spike, it pushes up perhaps the crude oil prices by 5-10%. Even in that case, food inflation goes up. Depending on which study you're looking at, for every 1% increase in fuel price, food inflation goes up by about 13 basis points, 14 basis points. So, all those concerns are there. If inflation doesn't cool, then the RBI has shown throughout 2024 that they will be reluctant to increase interest, to reduce interest rates as the industry wants. So I think that is the biggest risk right now.
Okay, and Rishabh, how do you manage this risk? How should one be balancing this risk that is there then? Risk and I want the returns. How should I balance that?
That's a very tricky question. The returns is something what is not in our control. The risk is actually in our control. So, I tell, everyone out there and my clients that, you can manage your risk, but, you can anticipate the returns, but actually the returns are completely not in your control. But to put it very simply, Vinnii, I think, there are two ways, easiest ways to manage risk and returns both. One is, in the debt space, currently sticking with high credit quality, which is AAA and sovereign debt funds, is something I would strongly recommend. I wouldn't recommend someone to, to chase a little more higher yields and go into the credit risk space. See, I tell this to my clients that, credit risk can be more riskier than equities at time. Actually, might as well if you want to take that much amount of risk, then you might as well invest in the equity segment, right? But debt is actually meant for capital protection, preservation, and then steady appreciation. A lot of people don't understand this, right? So number one is stick with high credit quality funds, high credit quality bonds and papers. And number two, match your time horizon with the maturity profile of the product. See, if you mismatch it, say if you are venturing into a long duration product, and if you have a shorter time horizon, then also it can be a bit of a trouble. Although, see, we are currently at elevated yields. So overall, there is ample of margin of safety at the longer duration, mid duration, and the shorter duration. But the easiest way is to sticking with high credit quality and matching your time horizon with the maturity profile of the product.
Okay, on that note, viewers, we're going to slip into a very short break, but we'll carry forward this interesting conversation after the break, talk about what is going to be looking exciting in 2025 in terms of a debt mutual fund. So stay tuned in for that. Welcome back to MMF Corner on CNBC TV18. We still have with us Rushabh Desai as well as Adhye to talk to us about the debt mutual fund market and what 2025 will look like that. Rushabh, let's come to you. Debt mutual fund in 2025, which category do you think will perform the best here? What is it that a viewer should look at right now if they want to invest in a debt mutual fund in 2025?
I see the overall yield curve still looks flat. So I see advantages in all three segments. It is the shorter end of the yield curve, mid duration, and the longer end of the yield curve, right? Still interest rates are in the peak range and the interest rate cut cycle has not yet begun. So I see more opportunity in the medium to long duration space. So over the next 1.5 or 2 years, I see that medium to long duration would do much better compared to the shorter duration. But again, mentioned earlier that one should stick with their time horizon and match their time horizon with the maturity profile of the product. So there are three categories where I feel that a good amount of returns can be generated. One is the corporate bond fund category. Second is the medium duration category. And third is the long duration category. So keeping high credit quality in mind, a combination of corporate bonds plus government securities in the medium to long duration would benefit more. But this has to be taken in the tactical portfolios in one bucket. this long duration segment cannot be considered as your core portfolio, right? So I would suggest that corporate bond funds should be in their core portfolio. Say probably 60% can be allocated in the corporate bond fund segment, and the rest of around 30-40% can be deployed in medium to long duration G-Sec funds.
Okay. And Udayan, how would you be, dividing this as well among these different categories? What do you think will be doing well in 2025? And overall, as a part of my portfolio, how much in 2025 should be towards debt mutual fund as well?
So, look, with regards to, I'm very sure a lot of viewers would be confused about these various categories, right? That we keep talking about: short duration, medium duration, long duration. So, one of the easiest ways to not get mixed up in all of this, if you have the bandwidth, if you have someone who can guide you along the way, go for it to find the right categories. But if you just want to do it in a very non-confusing way, one category that I particularly like is the dynamic bond fund category. Because in this category, the fund manager decides what duration of bond to invest in. So they can invest in short-term bonds, a mix of long-term, medium-term, corporate bonds. So it's entirely up to the fund manager's discretion. Now, this can also go wrong, right? Because if the fund manager gets it wrong, then you are at the receiving end. So it's good to stick to very well-reputed, well-run, long-running, high AUM fund houses in this case. The ICICI Prudential All Seasons Bond Fund, ticks all these boxes. So does the Kotak Dynamic Bond Fund. And just by investing in this, you just have to take out the decision part of it as to which category, which type of bond may do well. So that is one way to do it DIY. But if you want to try to time the bond market, I think the medium to long duration category makes a lot of sense. Perhaps investing about 50% of your money in it, 50% in either short-term debt funds or corporate bond funds, that could be a good idea.
Okay. Udayan, best time that, one should start investing in a debt fund. Is there something like a best time, or any time is a good time to start?
If you have the magic ball where you exactly know how the future is going to look like, I think, right at the top of the yield curve, which was about a year and a half, 2 years ago. But that doesn't mean that, now is not a good time, because there are no rate cuts right now that have happened in India. At the same time, the yield from the highs is down by about 1% for the 10-year bond. So we are not very far down. So I think even right now could be a very good idea if you have a lump sum amount of money, especially that you don't really need for the next, say, 2 to 3 years, 2 odd years. Then investing that in medium to long duration bonds could be a good idea. As I said, spread it across different durations, or just one dynamic bond fund. And if you have an SIP as a strategic asset allocation approach for your portfolio, then just keep continuing with that. But for the longer duration bonds, as the duration increases, just mentally be prepared that the returns could be a little more up and down, because that tends to happen with interest rate changes.
Okay, so with that sensitivity is there with those long duration funds in terms of interest rates. Rushabh, is there a particular time, if I'm going in for just a short duration, then do I need to be more aware of the time that I'm investing in a debt fund?
No, for short duration, there is nothing to worry about. You can deploy. Actually, theoretically, see, in a debt product, you really don't need to time it as such. Short durations are much more safer than long duration funds, because long duration funds can get very volatile and are very sensitive to interest rates, right? So we suggest that if you're venturing in the medium to long duration space, this is the right time at the peak of the interest rate, and when the interest rate cut cycle has not yet begun. And when the interest rate cut cycles begins, I think then venturing into the shorter duration papers or funds makes more sense. So short duration funds, there is no timing required, but of course, tactical allocation and timing will be required in the long duration funds.
And Rushabh, are short duration funds safer in this current environment to go for, or should one be going for long duration funds?
I think spreading across short, medium, and long duration is something what I would recommend. Again, matching your time horizon and maturity profile, I'm emphasizing it very, very thoroughly, is because of risk and returns. So overall, because the interest rate cut cycle has not yet begun, I think all the three buckets, whether it's short, medium, and long duration, are safe today to invest. So spreading out your investments, in short, medium, and long is something about I would recommend today.
Okay, spreading it out along and different categories and following with the different categories is what you would suggest. Within your take on that one, short durations, long durations, given the current scenario?
I think short duration funds, short-term debt funds, they are evergreen. Even during lower interest rate cycles, they will give you steady returns. Even during situations like right now when interest rates are high, we are expecting a rate cut, they could be a good idea. I kind of look at corporate bond funds and short-term debt funds in similar ways because their average maturity is similar. So those can be interchanged. But right now, if you're looking at getting that higher return rate of say in excess of 8.5%, 9%, then I think the medium to long duration categories, I think they make the most sense. But again, you don't want to put in all your money in just one particular fund or one particular category. You want to spread it across. So if the RBI, for whatever reason, right, we don't know why inflation may stay high, may go higher. But if that happens, then that 50% allocation to either corporate bond funds or short-term debt funds, that will just hold your portfolio together from a debt perspective.
Okay. And Udayan, just a last one. In debt mutual funds, SIP debt mutual funds, or what is the viable option? SIP or lump sum, what should they be looking at?
If you already have an amount that is sitting idle in your bank account, you're expecting a significant amount to come in, I think just go for a one-time investment. Don't try to spread it over the next 6, 7, 10 months. But that is if you already have a sufficient amount that you are expecting or you already have. But let's say you want to use it as a tactical allocation for your long-term portfolio because, ideally you should have some amount of safe elements in your long-term portfolio as well. Then I think SIP makes a lot of sense.
Sure.
And again, just spread it across different durations.
Okay. And Rushabh, your view, lump sum investing, does that look attractive to give better yields?
Absolutely, Vinnii. I mean, if you have cash in hand, then definitely go for lump sum. But if you don't, then of course going via SIP route is something what makes more sense.
Okay, Rushabh as well as Udayan, thank you so much for joining in with us and explaining me as well as the viewers about debt mutual fund. It was a very interesting conversation, so thank you so much for that. And with that, we are absolutely out of time on this edition of Mutual Fund Corner on CNBC TV18. Thank you so much for tuning in, but don't go anywhere. Closing bell is up next to take you through the last hour of trade.